Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor. Really pleased to have one of our most frequent guests, Alasdair Macleod, return. And I think I was just commenting to Alasdair, I've seen more and more, I'm seeing Alasdair appear on all manner of videos and television and so forth. And it's really great to see him because he is obviously a much sought after guest because he has a lot of great insights. And that's why I think people are looking to him more now than ever because of the uncertainties that are arising in our world, monetary and otherwise. So thank you so much, Alasdair, for coming on with us again.
I'm honored to be on your program, Jay.
Well, it's really great, and I'm glad you're honored because so are we. Goldmoney.com, the research page at goldmoney.com, folks, is where you should go every Thursday to read Alasdair's weekly missives. Great insights into what's going on actually under the surface, not what you get from the propaganda and the mainstream media, that's for sure. And that's why he is of value to us. I've titled today's show, Alasdair, The Mechanics of Fiat Money Destruction, because I think you explain why fiat money, given its absence, given the absence of gold and silver from it, it really has no intrinsic value. And given human nature, it seems to sort of this self-destruction repeats itself over and over again. We don't want the constraints of gold or silver to tell us we can't just do what we want to do when we want to do it. And so honesty be damned, and let's go with the fun stuff. Your article, The Great Unwind, the second part of The Great Unwind, you had an earlier one that focused on the banking system and how they're getting in trouble, the banks. And, that's what I'd like to explore with you and have you explain to our listeners, the mechanics of fiat money and the banks and how rising interest rates are really causing a lot of trouble. You start out the article, this is your November 3rd article, by assuming inflation is rising out of control. And I'm reading some pundits like Lance Roberts or Jim Rickards who think we're heading into a very serious economic downturn in 2023, and that with that downturn, rates will sharply decline. That's inflation and interest rates will sharply decline. Lance, for example, is even suggesting it might be time to start nibbling away at least at long-dated U.S. Treasuries. But it seems to me in reading your most recent work, you're not buying that, or at least not in the longer term.
No, I'm not. The interesting situation that we have, Jay, is that banks are under pressure to contract their balance sheets. And that basically means that they need to call in their loans, not new loans, reduce the size of their balance sheets substantially. Now, while they do that on the asset side, obviously, it's going to have exactly the same effect on the deposit side, in other words, the bank's liabilities. So we've got to sort of really understand what bank credit is in the context of the economy. Well, virtually all transactions in GDP are conducted or settled in bank credit. So obviously, if you get a contraction of bank credit, that impacts negatively on GDP. So that is what we're going to see. And I suspect that, you quoted Jim Rickards. I suspect that quite a number of people are seeing this and thinking that, well, this isn't inflation, this is deflation. This is a contraction of the amount of credit in the economy. Now, that undoubtedly is true, but we've got to take into account the reaction of the central banks. When the Fed sees bank credit contracting, what it will do is it will pivot. It will stop any thoughts of quantitative tightening and instead go into quantitative easing mode. What it would hope to do also is to stop raising interest rates and begin to lower them in order to protect the economy. That's what they will do. So what we're going to see is a replacement of commercial bank credit with central bank credit. Now, the problem is in terms of how this makes people look at the values of that credit, given that it's not anchored to money in any way at all, it is pure fiat. They will tolerate changes in the amount of commercial bank credit without, let's say, expecting, thinking they should change the relationship between the amount of liquidity they hold compared with the amount of spending that they indulge in on a day-to-day basis. In other words, they won't shift the general level of prices as much as they do when a central bank suddenly starts increasing the amount of central bank credit. That has a far greater psychological impact on individuals who use dollars, dollar credit currency for payments. So what you're going to see is not so. I mean, one of the big mistakes that everybody makes is they think that if the price level is automatically tied to the quantity of credit in circulation. No, it is not. That credit is actually valued by its users. And if they start running scared, it doesn't matter what the quantity is or what's happening to the quantity. The purchasing power of that circulating medium will diminish. And that's basically, in a nutshell, what I see happening. The other thing which I think people ignore is that when you get a contraction of bank credit, the shortage of credit leads to higher interest rates. And this is a problem that the Fed has. Effectively, they have lost control over interest rates. The consequences of that, I think, will really tend to make participants in markets begin to run scared, because once the Fed loses control of interest rates, we then face a situation where, with prices currently rising at around about 8-9%, probably continuing to rise, say, at 5 or 6%, even if the deflationary forces do manage to sort of quieten price rises down, you're still looking at interest rates which should be above the current level by a significant margin. And that would be brought about by the contraction of bank credit. So in effect, the Fed has a choice to make. Does it suppress interest rates again, flood markets with new quantitative easing in order to save markets, in order to keep the cost of government borrowing down, in order to hope that by stabilizing markets, that the economy itself, the underlying economy, Main Street, will stabilize and draw on that confidence from financial markets? Under those circumstances, then this sort of expansionary move and lower interest rates is fully justified. But the problem is that if they do that, they trash the currency. And that is the choice that they're going to have to make. My betting is that they have no mandate for protecting the currency. Well, not no mandate, but they have a far stronger mandate for ensuring that the government deficit is, if you like, contained as much as possible from by supporting the economy, and at the same time that unemployment doesn't rise very substantially, and all those factors. In other words, they will opt to support the economy rather than support the currency. And it's not just the Fed that faces this problem. It is all the major central banks. We're talking about the Bank of Japan, we're talking about the ECB, Bank of England, and obviously the Fed as well. So that, I think, in a nutshell, is where we are. And I would say that it's important to understand that the purchasing power of the dollar, which is no longer anchored to legal money, which is gold, and that's something we can explore. Yeah, because it's no longer anchored to it. You can find that the purchasing power of the dollar, if confidence goes in it, basically will collapse.
Yeah, it's a con game, isn't it? So, are you seeing evidence of banks withdrawing credit now to a great extent? Because I heard somebody, not one that looks at these statistics normally. So somebody I can't remember who was claiming that no reason to get worried about a recession now because credit, at least in the United States, is very strong. What are your thoughts on that?
One thing that I think we should bear in mind is that the U.S. commercial banking system is not nearly as highly leveraged as the Japanese system and as the Eurozone banking systems. They are extremely highly leveraged with asset to equity, balance sheet equity ratios in excess of 20 times. Now, that is extraordinarily high. In America, you have got, I think virtually all the major banks are over 10 times, but we're not talking about that real extreme. So I think the way to look at it is that in America, it's less so than elsewhere. But even then, put yourself in the shoes of a banker. Where are all your loans? Well, perhaps the majority of your loans are into the financial sector. In other words, you're supporting hedge funds, hedge fund borrowing, for example. You're supporting speculative borrowing. You're supporting positions in the derivative markets. Yeah. Now, what you're now seeing is the value of your collateral go down. I mean, if someone has lodged the long bond with you as collateral, since March 2020, it is actually halved in price. Yeah. So, that gives you an example of the sort of pressure that a banker feels on the loan side. And he can see that with rising interest rates, even as they've risen above where they went in 2019 and 2018-19, they're above that level now. There will be many of his customers, both in the financial sector and also in the non-financials, who will be running into loan difficulties. So he can see that his level of non-performing loans are set to rapidly increase unless he can get that situation under control as a matter of urgency. Yeah. So this idea that we're not going to see a contraction of bank credit in the US economy, I think is extremely false. You've only got to look at the level of margin debt, which is published by NASDAQ, and to see how that has actually fallen off a cliff. That is bank credit. That is supported by bank credit. So that has contracted. Yeah. You've only got to look at the broad money supply statistics. They're no longer expanding. In fact, they topped out. If you look at M3, that topped out in, I think it was May this year, and has been continuing to drift lower. And that doesn't necessarily reflect the whole position. Look at the loan officer surveys. They're all turning pretty bearish. So you can see that, yes, the conditions are in place for a substantial contraction of bank credit.
Yeah, and you didn't mention mortgages in the United States. It's a big deal. They're twice as 3.5% is a 7% mortgage now. And it's just absolutely killing the housing market. So that's such a major part of our economy. You have to think there's going to be some economic weakness that comes along as well, which will start to create, cause other loans to be in trouble on the books of those banks. One thing I want to ask you, Alasdair, you've talked in the past about a lot of the central banks themselves are having trouble now. I don't say they're having trouble yet, but they're at least on their balance sheets are not looking all that great because they own a lot of securities that they bought, bonds they bought when interest rates were 0 or 1% or 2% or whatever. And now those rates have skyrocketed. So those bonds are underwater. So the central banks themselves in many cases, and which leads me to a thought that Jim Rickards has expressed in the past, that he thought after the 2008, the next time around, the central banks themselves may not be in great shape to bail people out, to bail companies out, to bail governments out. What are your thoughts on that?
Well, that's absolutely right. This is now becoming more of a public issue since you and I first started talking about this. And we've seen the Dutch central bank, for example, claim that they don't have a problem because they just revalue their gold. I'm sorry, I know they've got a lot of gold, but it's not going to be enough to bail out the losses from the bonds on their balance sheets acquired as part of the ECB's quantitative easing. or special asset purchase programs, or whatever they call it. The Fed is deeply underwater, and they're riding it out, saying, well, we're going to hold these things to maturity, so mark to market doesn't really matter. Mm-hmm. The Bank of Japan is in the most terrible mess. They've been doing QE since the year 2000.
Yeah.
And that long-term trend of declining interest rates, has now reversed. They're getting deeper and deeper into problems. So really what we have is one of the functions of a central bank is basically to rescue failing commercial banks. So we're now in a situation where we see insolvent central banks being tasked with rescuing insolvent commercial banks. This is not going to end well.
Mm-hmm. And we have this inflationary problem, at least in part. It's not just the monetary aspect, but it's also some supply chain issues that have come into place in no small part because of geopolitics and sort of green energy initiatives that the West at least has started implementing. And I have to ask you about this ongoing war in the Ukraine. I know you felt that it would be certainly not in the best interest of the West to put sanctions on Russia. How do you see that playing out now? Your idea was that probably what Putin really wants to do is get the United States out of Europe, I suppose, so that he can have those markets to sell his gas and to trade with Europe. Is that what you're thinking?
I think, yes, it's partly that. I think there is this other Russian sense of insecurity when its borders are surrounded by its enemies. Mm-hmm. Fortunately, I think since we last spoke, there have been moves to try and get the Ukrainians to talk with the Russians. There's obviously been a lot of back-channel activity between America and Russia, and I think it comes with a realization from the American side that this is proving to be disastrous, not just for Ukraine, but for the whole of the NATO alliance and also the whole of the world. So they're trying to step back on this. And I note that there are parallel discussions been going on between President Xi and Biden, which look to me like, sort of, if you like, overtures towards peace. So on that basis, we have seen a major change. Now, I suspect that the retreat from Kherson is to do with creating a position whereby the Ukrainians can actually talk with credibility to the Russians. Feel that is why that's happened. Now, having said that, I don't think we've got a quick fix. We can probably have if you like, a ceasefire in the Ukraine, but when it comes to the situation with NATO, first of all, I think that the Russians are not going to want Ukraine in NATO, and secondly, they're going to want the withdrawal of threatening weapons in surrounding nations on her western boundary. So this is not going to go away easily.
No, I understand that within the administration here, there's some conflicting views on what should be done. And I might say that if we withdraw weapons from the Ukraine, that doesn't help the bottom line of the military-industrial complex companies. So I think there's a lot of desire to keep some kind of war going all the time, unfortunately. But and Americans don't see why Russia should feel threatened. Why, goodness, they should just let us take them over. Then they would be better off, right? So. Anyway.
Well, I'm sorry, but when it comes to sovereignty, that is always a no-no. Look at it the other way around.
Well, national sovereignty, are we really interested in it? Where the World Economic Forum wants to get rid of boundaries. We don't have one on our southern boundary anymore. People can come in, millions of people. We don't know who they are coming into the United States. We need labor, that's for sure. So that's good, I suppose, and to a certain extent. But I don't know. Does anybody really respect sovereignty anymore? I don't know. It doesn't seem. I talk to my friends, and I tell my friends I'd like to see Germany remain Germany, and Britain, and Denmark, and everything else. But they don't seem to get it. So I don't know.
I think sovereignty is actually very, very important in people's minds. I mean, it's not something that they consider every moment, but if you threaten to take it away, I think they very definitely have an opinion. So,
Yeah, yeah,
go on,
so
sorry.
we have a divided world too, in terms of this issue of Russia. And I just noticed this morning that the G20, they're having a lot of trouble getting everybody on board. That is the United States and Britain, to get everybody on board to condemn Russia for their actions.
I'm afraid that we're a minority. We look at NATO and friends. We are around about a bit over 1 billion people. Asia and all the rest of it, SCO and so on, you're talking about 4 billion. So we are in a tiny minority, and we're not going to get the support of, if you like, so-called independent nations like Indonesia.
With just a minute left, and maybe take a few seconds to tell us why you think gold hasn't performed better. It's done better in the last week or so. But it's sort of been a little disappointing, even though, as I pointed out in my monologue, that gold is only down 2.3 or 2.4% this year compared to 30% for treasuries, so it hasn't been bad. But are we going to see some sort of a rally in the precious metals now?
I think so, because with this pivot, I mean, it's clear that the word's going out that the Fed is going to pivot. And I think that means that gold will go higher in dollar terms because the dollar will go easier. But also, if you look at other currencies like gold priced in sterling and euros and yen, it's actually doing what it should do, is protecting citizens from the debasement, the debauching of their fiat currencies. So it's doing the right thing. And remember, it is legal money.
Yeah, we have to talk about that another time. Why is gold legally money? It's been deemed illegal money here in the United States. So we'll talk about that another time. Thank you so much, Alasdair, for being with us once again, for sharing your insights with our listeners. It's always appreciated.
My pleasure, Jay.